What do financial statements reveal after major market events? Imagine a sudden market crash or a big economic downturn. You might wonder what a company's financial health looks like after such shocks. Well, financial statements are the key to understanding that. They tell us how a company is really doing when times get tough. For a student learning about investing, knowing what these reports reveal helps make smarter decisions. First, the income statement shows how much money a company makes and spends over a certain period. After a big market event, it can reveal if sales have dropped sharply or if expenses have gone up. For example, if revenue falls significantly, it might mean fewer customers or lower demand. If expenses rise, it could be due to higher costs or inefficiencies. This report helps see if the company is still profitable or struggling to stay afloat. Next, the balance sheet gives a snapshot of what a company owns and owes at a specific moment. After a market crisis, it can show if the company has taken on more debt or lost value in its assets. For instance, if assets like property or inventory decrease in value, it indicates trouble. If liabilities increase, especially short-term debt, it might mean the company is relying more on borrowing to survive. This report helps assess if the company has enough resources to keep going. The cash flow statement tracks how cash moves in and out of the business. After a market event, it shows if the company is generating enough cash to cover its bills. Negative cash flow might mean trouble paying employees, suppliers, or creditors. If cash flow improves over time, it suggests the company is recovering. For students, watching these cash flows helps understand if a company can handle sudden financial stress. Looking at these three reports together gives a clearer picture. For example, if the income statement shows declining profits but the cash flow is still positive, the company might be managing its cash well despite losses. Or if the balance sheet shows rising debt but cash flow is tight, it could be a warning sign. Financial ratios derived from these statements are also helpful. The current ratio shows if the company can pay short-term bills. The debt-to-equity ratio reveals how much debt is used to finance assets. Profit margins indicate if the company is still making money. Activity ratios show how efficiently it uses its resources. After a market event, changes in these ratios can tell if a company is bouncing back, staying stable, or facing bigger problems. For students, a practical step is to compare financial statements from before and after the event. Look for increases in debt or drops in cash reserves. Check if profits are holding steady or shrinking. Understand what the company is doing to adapt, like cutting costs or investing in new opportunities. This helps you decide whether to buy, hold, or sell stocks during volatile times. By paying attention to what financial statements reveal after major market events, students can develop a better sense of how companies respond to challenges. This approach aligns with basic personal finance principles by encouraging careful analysis and awareness of risks. It's a simple but powerful way to become a smarter investor, especially when markets are unpredictable.